The global financial system has long been defined by the supremacy of the United States dollar, a currency that for decades has been not only a medium of exchange, but also a symbol of American geopolitical power. Across international trade, investment, reserves, and settlement systems, the dollar has dominated in a way that has often left countries dependent, vulnerable, and at times constrained by the financial and political decisions of Washington. Yet in 2025, an unexpected decision by Kenya to place billions of dollars worth of transactions, reserves, and trade settlements in China's Yuan has raised questions about whether this shift represents a momentary experiment in diversification or a historic pivot that could challenge the very dominance of the dollar in Africa and perhaps ripple across the wider global economy. Kenya's move toward embracing the Yuan was not made in isolation, nor was it simply a symbolic gesture. The roots of this decision stretch across years of financial pressures, economic restructuring, and the search for greater independence in global trade. Kenya, like many African nations, has found itself locked in cycles of debt, currency volatility, and the persistent struggle of balancing domestic growth with global expectations. For years, the cost of servicing dollar-denominated debt has strained its treasury, while access to dollars for critical imports like fuel, technology, and machinery has placed constant pressure on its currency, the Kenyan shilling. By shifting a large portion of its foreign trade transactions into yuan, Kenya is not only diversifying its risk, but signaling a potential strategic realignment with China, the world's second-largest economy and its single largest trading partner. This development has to be seen against the backdrop of sanctions and economic realignments that followed the Russia-Ukraine conflict, where the weaponization of the dollar and Western-controlled financial systems revealed vulnerabilities to countries outside the Western sphere. For many in the global South, it became clear that reliance on the dollar was not simply a financial matter, but a political gamble, one that could leave entire economies paralyzed if geopolitical alignments turned sour. China, observing this shift, accelerated its push for yuan internationalization, expanding swap lines, promoting yuan-denominated trade in commodities, and building institutions like the cross-border interbank payment system as alternatives to SWIFT. Kenya's choice to bet billions on the yuan, therefore, represents more than a domestic economic strategy. It is in alignment with this growing architecture, one that suggests Africa is no longer content to simply operate within frameworks dictated by Washington and Brussels. The move has been described by analysts as a bold gamble, one that carries both promise and risk. On the one hand, yuan usage could stabilize Kenya's trade with China, ease liquidity pressures, and reduce dependency on volatile dollar flows. On the other, it could expose Kenya to currency mismatches, increased reliance on China's economic health, and the political calculations of Beijing. But why Kenya, and why now? To understand, one must look at the interplay between Kenya's internal economic struggles and the broader international context. Kenya has, for years, been burdened by significant public debt, much of it denominated in dollars. Servicing this debt became more expensive as the Federal Reserve increased interest rates, pushing the dollar higher and weakening currencies across the developing world. Kenya's shilling, like many others, fell sharply, making imports more costly, inflation harder to control, and debt repayments ever more burdensome. In parallel, Kenya's trade balance revealed an increasing reliance on China, not just as a source of consumer goods, but as a partner in infrastructure, technology, and investment. Whether it was roads, railways, or telecommunications, Chinese financing and expertise were woven deeply into Kenya's economic fabric. The natural conclusion was that transactions with China could no longer sensibly pass through the dollar as an intermediary. In 2025, the Kenyan government announced that billions in bilateral trade with China would now be conducted directly in yuan, cutting the dollar out of the loop. This decision came alongside efforts to hold yuan reserves, allowing Kenyan businesses and banks to operate with fewer disruptions caused by dollar shortages. For local companies importing machinery, electronics, and manufactured goods from China, this provided immediate relief. They no longer had to scramble for dollars on global markets, but could instead settle transactions in Yuan at more predictable rates. For policymakers, this also represented a step toward insulating the economy from the political whims of Washington, where access to dollar liquidity could be influenced by shifting perceptions of U.S. foreign policy priorities. The implications for the dollar, however, go far beyond Kenya's borders. Although Kenya alone does not hold the economic weight to topple dollar dominance, the symbolism of an African nation taking this step is powerful. Africa has long been treated as a passive participant in global finance, dependent on frameworks designed elsewhere. Yet now, with Kenya joining a growing list of countries experimenting with yuan settlement, the continent is positioning itself as an active agent in the diversification of global financial systems. Nigeria, South Africa, Egypt, and even resource-rich states like Angola are observing closely, as the precedent Kenya sets could open pathways for broader adoption of the yuan across the continent. For China, Kenya's embrace of the yuan is both a victory and an opportunity. Beijing has invested heavily in presenting the yuan as a stable, reliable alternative for trade settlement, and having Kenya on board enhances China's credibility in promoting its currency abroad. It also strengthens China's grip on African markets at a time when Western powers are attempting to regain influence through new aid packages, development programs, and security partnerships. By aligning its financial flows with China, Kenya signals to the world that Africa's economic future may no longer be tethered exclusively to Western institutions, but could be shaped through a multipolar order where Beijing plays an equal, if not dominant, role. The West, particularly the United States, views these developments with growing unease. For decades, dollar dominance has been a cornerstone of American power, allowing Washington to project influence without direct military engagement. Sanctions, for instance, derive their effectiveness from the centrality of the dollar in global trade. If more countries follow Kenya's path and conduct transactions in yuan or other currencies, the reach of American sanctions could be blunted, and the financial architecture underpinning U.S. hegemony could be weakened. Already, global institutions have noted the slow decline of dollar holdings in central bank reserves, replaced in small but growing amounts by yuan and gold. Kenya's decision accelerates this trajectory, raising the question of whether dollar dominance is entering a period of irreversible decline. Yet it would be premature to assume that Kenya's pivot represents an immediate collapse of the dollar system. The dollar remains deeply entrenched in global finance, with its liquidity, security, and trust unmatched by any other currency. Oil markets, stock exchanges, and debt instruments are still overwhelmingly dollar-denominated, and China itself has been cautious in liberalizing its capital account to allow full convertibility of the yuan. What Kenya's decision represents, however, is a crack in the edifice, a signal that alternatives are being tested and that countries in the global south are willing to experiment with financial models outside Washington's control. The risks for Kenya cannot be ignored. By relying on the yuan, Kenya exposes itself to fluctuations in China's economic performance, political decisions in Beijing, and the possibility of being caught in the crossfire of U.S.-China tensions. Should relations between Nairobi and Beijing sour, Kenya could find itself just as constrained as it once did under dollar dependence, only with fewer options for diversification. Moreover, the yuan, while rising, does not yet offer the deep liquidity and global acceptance that the dollar provides, meaning Kenya's move carries uncertainty. Domestic critics have warned that tying Kenya's fortunes so closely to China could erode sovereignty in ways that may only become visible years later. At the same time, Kenya's choice highlights the deepening relationship between Africa and Asia, particularly in the context of a shifting global order. With the West increasingly preoccupied with its own internal divisions, Africa is forging partnerships with China, Russia, and other emerging powers, seeking new paths for development and independence. The financial dimension of the shift is perhaps the most telling. as it strikes at the very core of Western power. By betting billions on the yuan, Kenya is not just securing better trade terms. It is making a statement that Africa is no longer bound to a single global currency. For global observers, Kenya's embrace of the yuan is a microcosm of a broader trend: the gradual erosion of unipolar financial dominance and the rise of a multipolar economic order. This does not mean the dollar will vanish overnight, nor that the yuan will immediately replace it. Rather, it reflects a world where the monopoly of one currency is increasingly challenged by the realities of geopolitics, economics, and the search for sovereignty. Kenya may not topple dollar dominance alone, but its actions send a message that resonates across the global south. Dependency on the dollar is not inevitable, and alternatives, however imperfect, are emerging. In the years to come, the success or failure of Kenya's gamble will be closely watched. If the move stabilizes its economy, lowers costs, and strengthens its trade relations, other nations may follow. If it falters, critics will point to the dangers of over-reliance on China and the risks of abandoning the established financial system. Either way, the world is witnessing the early stages of a financial transformation, one in which Africa is no longer a passive bystander, but an active participant in shaping the global order. Kenya's bet on the yuan is thus not merely about currency. It is about agency, sovereignty, and the desire to redefine the structures of global power. For decades, the story of Africa has been one of dependence, but today, in Nairobi's decision to bypass the dollar, there is a story of experimentation, ambition, and resistance. It is a gamble whose consequences will extend far beyond the balance sheets of banks and traders, reaching into the very question of who controls the future of global finance. And while no single decision can topple the dollar's dominance overnight, it is the accumulation of such choices by Kenya, by other African states, by nations across Asia and Latin America that creates the possibility of transformation. The world order is never reshaped in a single stroke. It is reshaped in moments like these when nations choose to chart new paths, and in doing so, set in motion forces far greater than themselves.